Hello. Let me first introduce myself. I'm Ron Blanken. I'm the president and founder of Sci2 Tech, a small technology company located out here in La Jolla, California. And today I want to talk to you about how investors set equity prices. What I hope you'll learn from this talk is about a pricing model that I've developed, which allows you to use several data variables to calculate how investors set the equity price. And hopefully, by the end of the talk, you will learn how to forecast equity prices using the expected value of data variables. What do you need to know to follow this talk? You need an elementary knowledge of calculus, linear regression, and discounting at a very elementary level. Most economics undergraduate students and RIAs will be able to follow this talk easily, I think. This is a serious, work was done in a serious academic way. There's a draft academic paper in the SSRN database at the link listed below. And I would suggest everyone view the video first because I think I can explain the model much better verbally than trying to dig it out of a detailed academic paper. Let's first start from some preliminaries. Throughout this talk, I'm going to define the earnings to price ratio as E to PR. The earnings to price ratio, the earnings yield. Sometimes I'll say earnings yield. The stylized facts, as they're sometimes called, that you should be paying attention to are that over the database we studied, and these relationships are roughly true over the last century, the growth of real GDP was about 2.7% a year, and the real earnings growth rate was about 2.9% a year, and the earnings yield, the mean of it, although it fluctuates, is about 3.4%. So what one has is a picture of an investment picture where the real earnings growth is very comparable and limited by, some practitioners say there's a speed bump by real GDP growth. And in order to have real earnings growth, one needs to be investing money back into the corporation. So if the earnings yield, the real earnings yield is reinvested in the corporation, it promotes earnings growth and an equilibrium to the extent that the earnings yield the real earnings yield is reinvested. These two numbers should be very, very comparable, and this is the basis of the model that I've developed. Throughout, we're going to concentrate on the real earnings yield, and we'll explain why dividends, I don't think dividends are as valuable to investors as growing earnings. There are two ways to calculate the earnings yield. The first way is as a data problem. As a data problem, one just takes reported data variables and tries to make a model which explains, in some sense, that's the academic word, explains the time variation of the earnings yield. In these models, we're going to concentrate on economic non-hedgeable variables, and we're going to write the regression. We're going to develop a regression function for the earnings yield as a function basically of one or more variables, and we're going to demean the variables. And if you're familiar with linear regression, what this in turn produces is a constant mean for the regression. So one can then easily observe the effects of each variable on the yield without changing the mean. And you'll see that this is a very, very convenient way to look at the problem later on. We need variables with stationary means over long periods of time, of course, to do this. And what we want is a model with low error and high R squared. High squared is how much the data variables explain time variation of the yield. The other way of looking at this problem is by discounting. After all, when investors buy equities, they're expecting returns from the growing earnings stream. So if one were buying a bond, the bonds have fixed payouts for fixed times. In equities, there's no such thing. There's no guarantees. The durations are infinite, and the payouts can vary pretty widely. And this is what has created all the problems trying to produce a pricing model for equities. Present time, there is no, except this one, any pricing model for equities. Academically correct anyway. So if you discount a constantly growing stream of earnings, growth rate mu, and these, in what I do, the Greeks will be relevant to the discounting model. They're based on expirations and expectations and parameters of the model, and one also needs to assume a discount rate beta. And if you do that, you obtain the Gordon model for the yield. It's very simple, that the dividend yield is R minus mu, where R is a so-called required yield, and it's related to the discount rate or the required return on capital. And what we do, we're going to expand this simple discounting, and we're going to include a more modern kind of discounting in which the expected utility of the returns is a part of the calculation. So what's required to have a complete model is a connection between the empirical model and the discounting model. It's certainly true that the price changes in response to data variables. The question is, how do these data variables relate to the hidden parameters or assumed parameters and expectations of the discounting model? And that's what we're going to develop. This will produce, in the end, a complete asset pricing model. To do this, what we're going to do is we're going to assume that these parameters of the discounting model are unique functions of some data variable. And it has taken me a long time to find a single data variable that satisfies these criteria. And we're going to calibrate the model by simply requiring that they give the same pricing result, so that mu of x1, beta of x2 gives the same pricing result as the empirical model. So let's start with what I'm going to refer to as a linear empirical model. I will first define data variables as in their normalized form. A normalized data variable is simply the data variable minus its mean divided by its volatility, the square root of the variance. And you'll see that this is going to be very convenient for us in terms of talking about the earnings yield. And after a long hunt, you might say, I have been able to identify two classes of data variables which largely explain the earnings yield. The first one is based on sentiment. Sentiment, you might expect that if investors are very optimistic, they have high sentiment about the future, that they will raise equity prices. And this is exactly what happens in the model. And in the empirical model right now, we're just simply going to assume that the sentiment variable is characterized by the University of Michigan consumer sentiment variable. The other variable that we're going to look at is the trailing nominal earnings growth rate, which is defined as the growth rate over the previous year. It's the rate, not the arithmetic gain, to keep it in line with the concept that it's the rates that are important to investors. If you take these two variables, the normalized variables, and run them over our database, which runs from 1982 to current day, you get the following result, that the earnings yield is about 3.38%, which is what exactly we talked about on the first page, is there the mean earnings yield. And there's it's minus 0.62 Michigan, 0.91 EGN. In the bracket, we see the t-values. If you're familiar with regression, the higher the t-value, more significant the regressor is. We can see that they're roughly comparable in effect, and that they have opposite signs. You can also see that, for example, the earnings growth variable, suppose EGN is 1, because that just means that it's 1 sigma away from its mean. It increases the earnings yield by about 0.91%. So now you can see the power of doing this. It's easy to think about how much the each of these variables affects the actual earnings yield. I think it's also, I'd like to point out the signs of these regressions. The sentiment variable, let's say it's +1, it lowers the earnings yield, raises the price, and in fact, if you look at this more carefully, if you go back to the paper, you'll see it increases the volatility of the prices. The earnings growth, the trailing earnings growth, has the opposite effect. If it's +1, it raises the earnings yield and it lowers the price and it reduces the volatility. So this brings about the concept of the idea that there are two classes of investors, rational versus irrational investors. This is a common concept among Wall Street practitioners, that there are these different classes of investors. Some academics like Professor Schiller think that all the investors are irrational and that there's no hope of ever being able to explain asset equity prices. The investors that trade on earnings growth are actually rational investors. Rational investors in the utility, you'll see later on, in the expected utility sense, seek to reduce volatility. These investors understand the model that ultimately the growth rate is going to be G, 2.8% or whatever it was per year, and they seek to reduce the price volatility relative to the equilibrium price. If you come over here now, you actually see the data in the black. The black is the data, and you can see it varies widely in percents from it actually rises up to over 6%, or it can actually be as low as 0%. This occurred during the 1999 dot-com bubble. And this wide variation about its mean presents a very challenging data problem. The blue line shows the results of the regression, and you can see that it does a pretty decent job most of the time, but there are times when there are big errors. Let's just take a couple of obvious examples here. And around 1999, 2000, you see the big difference between the actual earnings yield and the one arising from the regression. What this means is that the prices, since the earnings were low, the prices were far higher than could be explained by the linear model. This difference between the two curves is the pricing error, and Just before we go on, let me just point out another one here. In 1987, again, you can see that the actual data, the earnings yield, went down to less than 2%. And as you recall, the price-to-earnings ratio was up above 30 astronomical levels. And you can see the rapid crash that occurred here. So what we're going to do is, on the next view graph, we're going to look at the error. The error is the difference between these two curves. So in this slide, I'm going to expand the linear model and make it nonlinear. Let's look first at the chart in the upper right-hand corner of the screen. Here I've plotted in the black the errors in the previous plot on the previous slide. And you can see the serial nature of these errors. They don't occur randomly like over here. For the most part, they come in long swings. These serial errors are due in the model to specific economic effects arising from the variables themselves. And to correct these errors, what we're going to do is define a new set of variables, which are defined by so-called data rules, which, when included in the regressions, correct the errors. So let me illustrate what I mean here. We'll start with the red, which is the dot-com pricing bubble that occurred in 1999 and 2000. And if you come up here, there's a data rule up here, which is defined on Mich N. If you recall, in the dot-com bubble, the most obvious reason for the large price increases was the huge amount of positive sentiment in the economy at the time. And so what I've done is to develop a new data variable, which I call Mich N P1. The P means positive 1 sigma. So if you come down here, the data rule is if the normalized Michigan variable is greater than 1, then it has a value Mich N minus 1, or else it's 0. So it provides data only during this period, which I've identified as red up here. And it provides a correction, a nonlinear correction. You notice that what this does is provide an additional price response to the data variable Mich N at very high values of Mich N. And this is, I believe, the way we need to explain bubbles, pricing data bubbles. I'm not going to go through all the other ones. Some of the other corrections are more complicated. For example, the one in 1987, that's number 7, occurred at high frequency, so I needed to change the data frequency in order to do the purple correction here. The correction here in 1991 to 94 arose from the extreme pessimism that occurred after the 1991 recession. And the green is actually very interesting. It is data rule 8. It has to do with the Fed. I think that the reason for the big error here in 2011 through 2014, the present time actually, arises because of the very low Fed funds rate. And it's very interesting because when the 1-year rate, it exceeds the, so this data rule applies when the inflation rate is greater than the 1-year rate. So in other words, the Fed has dropped the Fed funds rate so low that it's no longer producing a positive inflationary gain for investors. And what this means is that investors are going to increase the value of equities, which is, I think, the widespread view on Wall Street. This relation here provides the first quantitative estimate of the effect of the very low Fed funds rate on equity prices. So if we then include all of these additional variables, what we find is that that we run regression 10. This is regression 10 in the paper. You'll see that we have a vastly improved model with relatively small errors. The standard errors are now about 0.8%, and the R squared is about 71%. This is very good, and I haven't been able to find any easy explanation for this error. It remains a work in progress. So now let's turn to the discounting model, often called the consumption CAM. As you're probably aware, if you take a discounting model and you assume a certain earnings growth and a certain discount rate, you can come up with any answer you want for the current valuation of the equity. There are about a dozen of these models floating around Wall Street. All of them produce errors, and none of which have shown any capability to forecast returns. These models, in the model that's being developed here, an error in the valuation of the yield is simply an error. It has no capability of telling you whether the equities are over or undervalued, or that the returns will be positive or negative. So there are two kinds of discounting, as I pointed out before. There's the mathematical type, where one just assumes that the payout, whatever it is from the equity, is consumed, and you discount that payout at some constant discount rate beta. Now, it should be pointed out here that consumption is a generalized concept in these models. It doesn't mean you go to the grocery store and buy a loaf of bread. It simply means that you don't reinvest the payout in the equity itself to enhance further consumption down the line. And the most common model of the mathematical type is the Gordon model, in which the dividend yield is the required yield minus the growth rate, where the required yield, sometimes called the cost of capital, is determined by the discount rate. The more modern type of discounting is a discounting based on expected utility. In these models, at each time step, the investor receives a cash dividend, which the investor partially consumes, and he or she reinvests the rest in the equity, so that this reinvestment increases the lifetime consumption, but you have to wait for it. That's the idea of these models. The consume part is discounted, and the future consumption does increase, of course, with the reinvestment, but it takes later on in time. And the trade-off is determined by the curvature of the investor's utility function. Utility functions are the heart of the expected utility models, and I'm going to use the most common, simplest one in this model. It just says that the utility of consumption of the investor is C to the 1 minus gamma minus 1 over 1 minus gamma, where gamma is a so-called coefficient of relative risk aversion. Gamma, and you'll see this throughout the talk. What this says, it's easy to show this utility function is downward, is concave downward. The second derivative is negative. And so what this means is that each additional unit of consumption is less valuable to the investor. This makes a lot of sense if you just think about your daily life. Additional units of consumption just aren't as valuable to you as the one that brought you the present level of consumption, shall we say. The classic consumption cam, the C-cam as I'll call it, initially introduces a noise into the expected growth rate. And this has the effect of complicating the decision about how much to reinvest. And the classical academic models, which have been at the heart of academic finance, equity finance, for the last 40 or 50 years, have adopted the paradigm that the equity risk premium is controlled by this risk factor, sigma, which is the volatility of the equity. And that's being traded off against the risk aversion of the investor. For a given gamma, they say higher risk implies a higher return. The model that I developed questions this paradigm. And in fact, it doesn't use this paradigm. I think that there's a different modality that investors use to price the equities. This last paragraph just points out that there is no variable in the expected in the empirical model. And we'll see below that the stochastic volatility isn't necessary at all to explain the equity premium. So in this slide, we're going to develop the consumption discounting model. In the first step, we're going to assume the relative risk aversion utility function with coefficient of relative risk aversion gamma, and that I discussed in the previous slide. It's important at this point to note that gamma is not just risk aversion. It also governs what's the so-called elasticity of intertemporal substitution. What this means is that if you're delaying consumption by reinvesting a part of the dividend at each time step, you have to be willing to delay consumption in return for getting more consumption later on. And this parameter is called the elasticity of intertemporal substitution. And it's for the simple model, it turns out that it's just the reciprocal of the coefficient of risk aversion. There are more complicated utility functions that separate these two effects, but I found that it's not necessary to do this, to develop the pricing model that has a high accuracy pricing model. In step 2, we're going to define a variable x in terms of the parameters of the discounting model. Mu is the growth rate expectation. It's about 0.3% a year to give you some stylized numbers. Gamma is the coefficient of risk aversion, which is in the range 1 to 4. At least all the microeconomic studies have suggested that this is the range for the risk aversion that investors actually possess. And sigma is the growth rate volatility. And I will come back to this on the next slide or two. It's not clear what volatility actually to use, because volatility decreases with time horizon. And so we have to begin to understand the horizon of the investors in order to even begin to discuss growth rate volatility. The usual volatility is just defined here as the difference in the logs is just the mu, the mean growth rate, plus a normalized noise variable characterized by sigma. So then x is 1 minus gamma mu. This is the term that determines the intertemporal substitution. And the second term is a term that considers the risk aversion, the trade-off between risk and risk aversion, in setting the is setting X and ultimately the yield. And you can then derive, it's not so difficult, this is a classic model. It's not difficult to show that the price to dividend ratio is then beta e to the x divided by 1 minus beta e to the x. And this is the classic CAM dividend pricing model. And what I'm going to do is just note that in the limit as x goes to 0, you can see x is very small, at least the first term. U is about 0.03. Sigma, even if you take volatility, typical volatility numbers, this term is also very, very small. So you can expand the exponentials here. And if in addition I assume that beta is very close to 1, which means that we're doing very long time discounting, we can then rework this equation in the following way. And what you, by expansion setting beta 1, you can easily obtain that the dividend yield is gamma minus 1 mu minus 1 minus gamma squared sigma squared over 2 is just minus x. And so this result requires only that x be small and that beta be close to 1. There's one important thing, very important thing to point out at this structure, as this stitcher in time. It's that the first term has to exceed the second term. Otherwise, we have a negative dividend yield. And this, I think, this has not been generally recognized in the academic models. In fact, this term typically, if you're just dealing with consumption, this term is vastly smaller than this term. And it creates a nightmare because if you try to increase your risk aversion gamma to fit these, for example, the mean dividend yield, you've also got to increase gamma here, and this increases much faster. This, because it's a quadratic, it's squared, it increases much faster than gamma, and this creates a modeling nightmare, I would say. You can find a solution to this equation, but it's a very, very special equation, and it falls apart as you begin to vary sigma at all over time. In this slide, I'm going to adapt the basic CCAM and place it in a growth environment. I'm going to define a dividend as any consumption that can be obtained from an investment without changing the earnings growth rate. What this means is that there are two different kinds of dividends that you could consider. The first is the ordinary cash dividend. Such a dividend is taxed. It's what's in use in the model. It's described in the previous slide. But dividends are not as good as growth. The dividends are taxed. There are reinvestment costs, of course. You have to pay to buy new shares. And there are also opportunity costs. You might not be able to, if your dividend is only 1% of your investment, you may not be able to buy an even number of shares, which increases costs even more, for example. The other way you can get yourself a dividend is you can give yourself a growth dividend. So suppose you buy Apple, and Apple goes up 20% a year. It's now worth 20% more after a year. Now you have a very nice choice. You can either just let it ride, or you can sell some of the appreciated stock and receive capital gains rates. This is a far better way of increasing your wealth than by taking dividends. And this is why I think almost all of the major growth companies don't pay dividends at all. whether they buy back shares to give dividends. That's also another great way to give investors money. It's sort of the opposite of making your own growth dividend. So I'm just simply going to use the real earnings yield, which I've defined previously as E to PR, as the valuation parameter. The investors in this model price stocks for real returns based on real earnings. And I just repeat the definition of the utility here, noting that 1 over gamma is the elasticity of intertemporal substitution. And I also note, again, going back to the second slide, the numbers here, that the mean earnings yield, the E to PR, is about 3.4%. So let's just using some rough numbers. If you just drop the second term here, if sigma is 0, then the growth rate is about 3%, 0.03. And if you have a mean earnings growth rate, mean earnings yield of about 3% also, this requires a gamma of about 2 to make the match if sigma is 0. So everything looks good here, except that we still have the second term to deal with. Then the academics will ask the question, well, what produces the equity premium? And I'm going to come to that in a later slide. But the technical question is, what sigma should we really be using here? And this depends on the time scale of the investor, I think. In the chart here, what I've plotted is a log of the real earnings versus time. The log of the real earnings is taken from Professor Schiller's database. And you can easily go back and do this yourself. And what I've done is drawn this yellow straight line. This is a constant growth line of about 2.5% a year. And what you can see is that since about 1920, this is what investors have, what they've learned. What they've learned is that over long periods of time, the earnings growth rate is very comparable to GDP growth rate. And it's punctuated by periods where there are recessions, economic events of various kinds. But after the events, the earnings growth rate, the earnings pop back up to the this line that I've drawn. So the message of this is pretty clear, and this is a message that's preached continuously on Wall Street, that you should be a long-term investor. If you're willing to ride out the bumps, you can obtain this this wonderful result, which is that your real wealth increases at about 3%. Real wealth increases at about 3% a year. So let's come back to the volatility question. So with the fun of it, I went ahead and I added a volatility component to the to this 2.5% constant growth rate here. I think in this one it was about 0.1 per year. And so if I start off the growth here in 1922 or something and start looking at possible paths for the earnings based on the constant growth plus the volatility, you get all kinds of different paths. And this took me about 3 or 4 tries, and I got this one. And now actually in the expected utility model, the discounting, you really need to consider all of the possible paths. So the question arises, is this really a possible path that investors will consider when they're doing the discounting? This has been questioned recently in the econophysics literature, there's a reference in the paper to it, and I think that this is correct, that this volatility, which is based on quarterly dividends, very high rates, volatility rates, isn't correct for the investors. The vast majority of investors are going to go to the first term. They're going to seamlessly, unless they really desperately need the money, they're going to just let their gains ride. And they're going to say, if they're saving for retirement, they may wait 30, 40, 50 years before they actually begin to take out the gains. So, and if you were to compute the volatility, say for a 50-year horizon, you'll see that the volatility is really negligible. An investor has nothing to fear from, I wouldn't say nothing, but little to fear from these deviations, because the earnings growth over those periods of time is so much larger than the deviations from the growth curve. And so I think this is actually the resolution of the problem of the volatility, that for equities, at least, for long-term investors, let's assume that most of the investors are long-term, and short-term ones are just playing with noise, that the volatility is expectation. Remember, this is an expectation. There's no this is what you would have to expect the volatility would be over the next the period of discounting, which could be very long. So I think this number is very small, and this would make this term, the second term here, very small. And then this relationship, you obtain what I consider to be the pricing model, which is that the real earnings yield is simply gamma minus 1 times mu. And you can see this has remnants of the Gordon model, which is the required yield is gamma times mu minus the growth rate mu. So I've often referred to this model as the micro-founded Gordon asset pricing model. So now I'm going to go ahead and connect the empirical model to the micro-founded Gordon model. The key to doing this is to use a Taylor expansion of the parameters and expectations in the discounting model. So if we come down here, we see what I've done is to assume that the growth rate expectation is related to the trailing earnings growth variable, and I've just simply expanded the function in a Taylor series. So it's mu0 times the derivative of mu0 with respect to the earnings growth times the normalized variable itself. The sigma here is to compensate for the fact that this is a normalized variable, which is normalized by sigma, so it needs to be taken out if you're doing a Taylor expansion. And in the same way, I've identified that the risk aversion is connected with the sentiment variable. This makes a lot of sense, at least to me, because investors are very happy. They go out and buy stocks. Their risk aversion decreases, and vice versa. If they're very pessimistic, they don't buy stocks. They don't raise the price. And so these are the natural associations of the data variables with the parameters of the micro-founded Gordon model. And so to match this up with the empirical model, we're going to go through a order-by-order comparison of the empirical model with the expansion of the micro-founded Gordon model, which we'll see on the next slide. Okay, now we're going to go ahead and connect the empirical model and the micro-founded Gordon model order by order. The first two rows show the expansions of the two models. So for the empirical model, we have the earnings yield is a constant, the mean of E to PR plus a regression coefficient times the normalized earning growth variable, and the same for the sentiment variable. In the microfounded model, we have that the earnings yield is gamma 0 minus 1 times mu 0. And then we have the expansion, which we've taken out. To extract this, there's a gamma naught minus 1 in the front of this derivative. And similarly for the sentiment variable. And the key thing to note then coming down here, first, well, let's start first with order 0. We know that if we assume that the investors assume the historical growth rate, mu 0, which is about 3%, and we also know that the mean of the earnings yield is about 3.17%, you can then extract the equilibrium, I'll call it the equilibrium risk aversion parameter. It turns out to be about 2.17%. And again, I guess I'll point out that the mu 0, gamma 0, and the expected utility literature is known as is due to precautionary savings. If we now come down here, for example, to order 1, we'll see, we come in this row, we'll see what the match requires here. So what we see is that it's the regression coefficient, which is related to the gradient of the variable in the discounting model. So for example, this is the regression coefficient is gamma 0 minus 1 times the derivative of mu with respect to the normalized earnings growth variable times sigma. And similarly for the sentiment variable as well. So now, for the first time, we understand what these regression coefficients really mean. What they mean is, what they're telling us is, or what the derivatives are, the slopes of the parameters of the discounting equation are. And I think this is a fairly big advance in our capability of understanding equity prices. You can then go on and obtain the actual expectations and parameters in terms of the regression coefficients, doing a little arithmetic. And the important one here, I think, the most important one, is the earnings growth expectation. You see that the earnings growth expectation is now the constant plus a 0.91 is the regression coefficient times the normalized earnings growth variable. And note how different this earnings growth expectation is than the rational expectations earnings growth expectation used in the academic models, where they simply add a noise variable to the growth rate. In this case, what's happening is that investors are actually modifying their views about what the earnings growth might be based on their observation of the current earnings growth rates. This is known as a kind of adaptive expectation, and this is one of the most fundamental differences between the model that I've developed and the academic models, which are based on stochastic noise. And this does not mean that the earnings growth expectation is not secular. What happens is that since this is normalized, the earnings growth variable is normalized about its mean, what it means is that the earnings growth expectation just varies about the adaptively varies about the equilibrium value as time goes on. So we have a similar result for the sentiment variable, and the last row, I think, in the last row I've tried to state explicitly why these relationships are so important. The zero order basically verifies expected utility approach to equity pricing. There has been no verification of this since there has been no pricing model at all. It's still conceivable that, and academics still talk about discount rates, time-varying discount rates as being responsible for the pricing. And additionally, very important contribution is the identification of an irrational investor class. These investors that trade on sentiment increase the price, increase the volatility. They are not part of the homus economus paradigm that has dominated academics finance for the last 50 years. They're more in line with what Professor Schiller or many Wall Street practitioners believe, that there are some class of of investors that trade on sentiment. And if you think about it, that it must be the way it is, because by looking at the nonlinear behavior of sentiment, for example, one can, for the first time, in a quantitative manner, explain bubbles as being due to the nonlinear behavior of the sentiment as at very high values of the sentiment variable. In the paper, I just mentioned in passing that this is explored in a lot of detail in relation to so-called habit models, and I even tried to extract a third-order term out of the data, although data is very sparse, so this should be taken as very qualitative, but it does look like the sentiment effect is most pronounced when at high and low values of the sentiment variable. This is very much in line with some of the work that's been done in the habit models. You can look in the paper if you're an academic to see the details. Okay, now that we've developed the model, we're in a position to examine some of the most important questions that have dominated finance over the last 50 years. The first subject I'd like to talk about is rational expectations. Rational expectations have become extremely controversial. They were since the 2008 recession, because they lie at the heart of all of the academic macroeconomic models. They've been in use in terms of pricing equities since the 70s. They were originally developed by Muth and by Samuelson and others. This is the idea that investors on the average know the future, and therefore they can discount the future based on it being on average correct, and that they just make random errors about the mean of whatever they're expecting. We see in our model that this is not the way it works. Well, it's actually true that on average the investors have the same expectation, because the data variables vary about their own means. But in any particular instance, the data that the investors actually are observing is used to modify the expectation. This is a viewpoint, this is what's called adaptive expectations. And The adaptive expectations received a very bad rap in the 50s in another context. This is quite a different rendition of adaptive expectations. So if one doesn't have rational expectations, then you have to do what I did. You have to dig out the data to find out what the expectations are by fitting the empirical model with a discounting theoretical model. And this has not been done in any, either in the finance literature for equities or in the macroeconomy generally. This then also brings up the question of the efficient market hypothesis. The efficient market hypothesis is also extremely controversial. There are many different versions of this, and I'm not going to go into a lot of details. It's very well recognized that you cannot even begin to talk about a market efficiency without a pricing model. So, having derived a pricing model, I think for the first time, I thought that we should discuss the efficient market hypothesis a bit. Again, the growth expectation is not a rational expectation of the future data variable. So the actual future data is not discounted into the price. And this suggests that prices can be forecasted to the extent that the economic data variables can be forecasted. The data variables are economic in this model, and they're not stochastic, and they're not hedgeable. So forecasting prices may be difficult, but I think it's theoretically possible, and we're going to discuss that in the next slide. And this, in a certain sense, invalidates the efficient market hypothesis, because an investor with a sufficient ability to forecast economic data variables can, in fact, to a certain limited extent, forecast equity prices. The last thing we need to discuss is what has been the major objective of academic research for the last 50 years, which is to explain the equity premium. And as I pointed out, the current generation of academic models attempt to explain this premium on the basis of the stochasticity of the earnings growth or the dividend growth. In this model, there is no stochasticity, or at least it doesn't play a major role. And so how does the equity premium arise? Well, the equity premium at its heart is the real return on the investment. So it is the premium over inflation that one obtains by investing in the equity. Real yields yield real earnings, yield real returns. That's the basis of the model that I've developed. So, but what are the academics comparing what is the usual quantity to which the equity premium refers? It's typically taken to be an investment in a riskless bond. But I will point out that the yield of the riskless bond has nothing to do with the volatility of the earnings growth rate. It's set by the Fed, typically using, in response to its dual mandate, using Taylor rules and so forth. And an investment in a riskless bond typically leads to little or no real return, although especially if one is investing in rolling over short-term bonds, that's in fact comparable. If the decision is quarterly, like dividends, then you have to use a short rates Fed rate, and one never obtains historically much more than an inflationary return from such investments. So the equity premium just arises naturally as the real earnings growth compared to the return that we might obtain from a bond whose return is tied to inflation. So I guess you might say the equity premium is just really an inflation premium. That's the best way to view it. So now I'd like to talk a little about forecasting equity prices, and I've made prices in a red color because typically up to now prices have meant forecasting returns. And what I'm going to talk about, I want to actually make a point forecast of the equity price using the model. The first thing I guess we should understand is that Keynes himself thought that forecasting prices is impossible, because if investors are in fact discounting the future, having expectations to forecast a price, one would need to have expectations about expectations. In the model, the microfounded Gordon model, the price depends only on reported economic data, and the investors use the reported data to modify their expectations. So price forecasts require only forecasts for future earnings and sentiment. And so on the chart on the right, I showed you how this might go. In this particular case, I've ended the regressions and the fitting at the end of 2012. And so to the left of the blue line, these points are basically in sample, and the green points, regression results, are out of sample. And the black is the actual value of the SP 500 during this time. And what we find is marvelous agreement. This I chose this just for illustration. There are very big error bars, which I'll come to in a minute, which aren't shown here. But at least it shows that the model gets the gist of the S&P growth correct. It shows you the dangers of just relying on the simple model. You see that the forecast goes from 1700 down to 1550 or so in just a month or two, depending as the data variables changed. So one has to be very careful about making exact forecasts. You have to pay a lot of attention to the forecast error. I'll say a few words about that in the next view graph. For this particular run, the standard error is about 0.83%, and the resulting pricing error, which includes the inflationary floor, computes to about 13%. So the pricing error here is less than the yearly volatility of the price, which is typically about 16-20%. So this just provides an example of how to use the model. You can actually use the regression models that's in the paper, the full model. You need to run the full model and provide yourself with some forecasts. So I want to say a few words about this in the next view graph. So let me conclude. The first point, of course, is that the ultimate test for an asset pricing model is how well the model is able to explain the variation of asset prices over long historical periods, and I think I've demonstrated that the model that I've developed is capable of doing this. The crucial issue, besides the pricing error, another crucial issue is will the model continue to be appropriate or give good results in the future, because investors are making investments, especially investors in equity making long-term investments. So a pricing model really needs to have a more fundamental structure that will assure investors that the next time it won't be different. So it needs a micro foundation. The micro-founded Gordon model differs in two important respects from current academic research. The first is that there are irrational investors that trade on sentiment. Sentiment is defined as any data variable that affects investors' risk aversion and has a sensible mean over long periods of time. The second significant way in which it differs is that the earnings growth expectation is not stochastic, but rather changes with the trailing earnings growth. And this would question the use of rational expectations in macroeconomic models, I think, as well. But it does verify that investors do use, at least the rational investors do use expected utility to set the equity prices, and it verifies that irrational investors are responsible for asset bubbles. One bottom line you might take away is that equity prices follow the economy. They are not mere statistical, how shall I say it, they're not just statistical magnification of stochasticity versus utility. They actually do follow the economy. There's lots of things to do, of course. Especially important is the nonlinearities of the data variables when the normalized variables are above 1. Here, I think some microfinance, there's very little data, and microfinance input might be very helpful there. It might also be interesting to examine the symmetry between the positive and negative values of the sentiment variable. For example, the behaviorists believe that there would be differences between the responses there, and it would also be of interest to examine this type of a pricing model over longer historical periods. I already made a start on this in the academic paper going back to 1970, and now we're here at the punchline. You might wonder why I've put this model in the public domain. There are, I guess, two reasons. The first is that I'm a physicist by training, and I believe in academic research very much. And the model, the equilibrium base model that I've presented here, I think represents a new viewpoint concerning how equity assets are priced, and it's rich for academic research. The second, which is, you might have guessed, is that my company now has some more what I would call advanced forecasting models beyond what I described in the previous view graph. These models use some variants of the basic variables, and they use some error correction methods, which are totally new and different. We have some patent applications for some of this work, and so and we're developing portfolio construction methodologies which use this type of methodology rather than the old mean variance portfolio construction methodologies, which were developed in the 50s. So for practitioners, I think you can save yourself a lot of time and money. We can help you do modeling, and we're prepared to do this for you. I welcome any comments you have about either the talk or the work or anything else, and you can always get a hold of me at my email at blanken@sci2tech.com. Thanks for your attention.